I'm Marella Fernandez. Thanks for joining us today on Market Call. Happy Monday to you. Michael Sprung on the show today. He's the president at Sprung Investment Management. And today he's taking your questions on Canadian large cap stocks. Here's how to reach us. If you want to call us, you can do that toll free, 1-855-326-6266. You can also email your questions in, marketcall@bnnbloomberg.ca. Michael, thanks very much for coming in today.
Well, thank you. It's good to be back.
On election day,
yes,
of all days. Exactly. So thank you very much for sharing your time. What do you think investors are looking for out of this election?
Well, I think investors are looking for a change. I think we've got the last 10 years, it hasn't been the most investment-friendly government. And given the uncertainty that's happening around tariffs and everything else, I think people are realizing that we have to make some investment in our economy. And that investment can be, anything from companies being able to plan ahead and make capital expenditures to government supporting resource development and industry expansion and that sort of thing. So I think really the investment community is sort of on tenterhooks, sort of hoping that we're going to see a real change of mood going forward.
Do you think that the leaders of the major parties have provided enough clarity, because you mentioned uncertainty, on how they're going to handle the unpredictability of Donald Trump?
I don't think they know, to be perfectly frank. Everybody's talking about a change in trading relationships. Well, that's going to take a few years to develop at least. You're talking about interprovincial trade barriers. Well, that's nice to talk about, and we've talked about it as long as I can remember. But in reality, you're dealing with provinces that have their own jurisdiction.
Sure.
And to say that, we're going to allow doctors to practice wherever they like, well, who's going to pay them? If they all want to work in Ontario, is Ontario going to eat that?
Yeah.
I don't know. So there's so much to be worked out there. The one area they could attack, I suppose, is resource development and try to take a lot of the red tape out of that. The other one, both parties are talking about home building and getting our construction trade going again. Well, we need the manpower to do that to begin with. And then you're reaching really deep down into municipal politics and getting them to change some of the things that actually their fees come a lot from that development.
Yeah.
So how are you going to make things more affordable by building more of the municipalities? Say
it's easy enough to promise, hard enough sometimes to get done, right?
Exactly.
Both of these leaders, the Conservative and Liberal leader, says yes, we need to focus on energy and resource and make sure we build out on that, but you have to get the provinces to play along with that. And that's not easy to do.
No, and I don't think it's going to be easy.
Got it. Let's talk about investors in a moment, about how you're steering them, given the big picture and the big cloud hanging over us.
Well, I think fortunately, as value investors, we're in companies that we believe can ride out the storm. And, if you look at it more recently, and value has been outperforming growth, I think. A lot to do with the uncertainty in the environment, because people like to know that what they're paying for, they're getting something more immediately back. And I think that's a trend that's likely to continue going forward. And, when markets get panicked like this, if you've got your portfolio set up properly, the best thing to do is nothing. It's because you're confident of what you're holding and that you'll be able to ride it out. You might do the odd trim here and there, and you might look for the odd opportunity, as some of our stocks have come down quite a bit.
Sure.
And you might say to yourself, well, gee, if I'm a longer term investor, shouldn't I be getting a company like that in my portfolio if I don't already have it?
Time to pick things up if they're worth your while. But as you mentioned, getting the panic out of it is really the harder thing to do for a lot of investors. Michael, let's leave it there, because we're going to take a quick break and line up the first of our phone calls. Michael Sprung with us today, president of Sprung Investment Management, taking your questions on Canadian large cap stocks. Back in a moment. Welcome back to Market Call. Let's go right to your questions. The first one in an email from Dana. Dana says, could Michael comment on CN Rail? I'm looking for a good entry point. Okay, let's pull up the chart for CN Rail and see where we are today. Down to 134.43 over the year, down 21%. Is it a good time, and would you pick up CN Rail?
It's certainly one that we've been looking at. We don't have any exposure to rails right now, but the rails in general have pulled back quite a bit with the fear in the economy of an economic slowdown. And, you know, the one thing railroads are, it's a measure of GDP levels. And so I think that it's a good time to be looking. And in terms of CN in particular, I think I would favor it a little bit right now. I mean, you're paying a slightly lower multiple for it, actually, and buying a higher ROE. Now, in terms of what you're buying and what you're getting, price to book wise, you're paying much more in CN than you are in CP. But I think that you're getting more by paying more, and I think it pretty much more than evens out a little bit in favor of CN right at the moment.
Because trade has slowed down to the U.S., especially from Canada, given the trade war and the tariffs, I'm wondering if you would watch it a little bit more to see if it's going to go down a little bit more, or just pick it up where we are today a little bit and go in bits and spurts.
Well, you know, it doesn't hurt to initialize a position when you see things that have pulled back as far as they are. It really depends on your sense of timing and how long a term investor you plan to be. But I think that investors could safely be adding some here, and if it went down much more, you could add some more. But I certainly would suggest that after seeing the decline we've seen, that it's worth looking at.
Got it. Okay, let's get back to the phone lines then. Nazar's on the line calling from Scarborough, Ontario. Hi, Nazar.
Oh, hi. Great show, Mariella.
Thank you.
Good to see you, Michael, again.
Thank you.
May I have your thoughts on ChemTrade logistics, please? This specialized chemical industry is going to face the Trump tariff. Will it ride out the storm? I recall this was your top pick not too long ago. It has a nice dividend yield. Thanks for taking my call.
Okay, let's have a quick look at where ChemTrade is today. I had it up just a second ago. We'll move back on it. So 963.64, and it was up over 11 at the start of the year, dragged down like everything else.
Yes, I think it was a top pick of mine actually in November.
Got it, okay.
So not too long ago, just before the water broke.
Yes.
But I think there's a lot going on behind the scenes with ChemTrade. You know, one of the reasons I picked it as a top pick is they're one of the leading providers of industrial chemicals in North America. And as I was explaining on the show, a lot of those chemicals, it takes a lot of energy to make them. And in North America, we have a bit of an advantage that way. The thing that I didn't see coming, well, there's a couple of factors. It's often compared with a larger company in the U.S. called Olin that does a lot of the same things that ChemTrade does, but it also owns Winchester, which is the rifles and guns. And I think a lot of people stocked up before the election on that, and sales have gone down in that area. And so it's gone down, and I think ChemTrade has followed it. The other thing is more unique. There was a campaign in Vancouver on a website called Keep North Vancouver Safe from Chlorine.
Oh.
And ChemTrade has a chlorine plant there, and it pretended to be from environmentalists, but it was actually a competitor.
Got it.
That was advertising this, a competitor by the name of Kate.
And do you think that affected them as well?
I certainly do. I think, I think in the Vancouver area, they were quite aware of this campaign to, should they shut down this chlorine plant?
Okay.
And fortunately, they survived through that, and I think that's behind them now. So it's really just a question of, yes, they probably will not go up to where they were immediately until we see the economy picking up again and the more use of the industrial chemicals that they produce. But I think that it's a good buy right now.
Got it. Okay, let's go back to the phone lines. Dominic is on the line. He's calling us today from Montreal. Hi, Dominic.
Yes, hello. Thanks very much for taking my call. Michael, I'm calling about Rogers, but I'm hoping to get an insights on comparison between Rogers, Bell Canada, and TELUS. Rogers has a dividend just under 6% at a very low price-earnings ratio. Bell Canada is, of course, expected to cut their dividend, but I wonder by how much and how much of a cut is baked into the price of Bell Canada. And TELUS is about 7.75 dividend with price earnings of 18. I wonder how you would value these three companies and which you prefer.
Okay, thanks for the question. Telecoms have been struggling lately in BCE, of course, under Bell Media, the parent of this company,
yes.
And CTV National News. But there's been a lot of, it's been an upward slog, I guess, for some of the telecom companies.
Well, it has been, and part of that is the slowdown in immigration, and in a period of uncertainty, maybe people aren't renewing their cell phones and turning them over as fast as before. But the one thing that the telcos have got going for them is, there's just going to be a growing demand for bandwidth and services and, the ability to get data and so on. And so these companies still have to, support that in terms of CapEx. And what we've seen recently, I think with respect to Rogers and now TELUS to some extent, is they're trying to monetize some of those assets by selling interests in the towers and giving part of the cash flow to the investors on the way through.
My understanding is they do that in the U.S., but Canada hasn't really taken that route.
Well, Rogers is certainly talking about it, and TELUS has actually announced
they're doing
that they're going to try to do it. And, the idea behind that is, can they remove, well, if they sell 50 or close to 50% of those towers, will that money coming in then be used to reduce debt, which all of the companies are trying to do? And I think that it generally will be looked on as positive. In terms of Rogers in particular, yes, they have a very low PE relative to the others, but it's also they have a lot of debt and they've bought a lot of assets. I mean, they're also talking about how are they going to monetize this sports.
Yes, they seem to be very focused on the sports angle now.
Right, and in terms of TELUS, well, we've already talked about that. And BCE, it's my belief everybody has baked in a 50% dividend cut. But even at a 50% dividend cut, you're still going to get a pretty good yield if you buy it today.
Got it.
So I think that all these companies are trying to improve. The long-term fundamentals work in the telcos' favors, but it could take a while for all this to work out. In the meantime, why not take advantage of the yields while you can?
Okay, good advice. Michael Sprung is sticking with us. We are going to take a quick break. Back with more of your questions in just a moment. Welcome back, and thanks for joining us on Market Call. We're going to get right to your phone calls. Michael is on the line. He's calling us today from Vancouver. Hi, Michael.
Hello, Michael. Michael, thanks for taking my call. Michael, my question is on TFI. I'm just wondering if you look at it as a buying opportunity now. It is at about a 3-year low, and basically, again, is it an opportune time to buy, or would you wait for some of the tariff talks to clear themselves up? Thanks, folks. Hey, have yourselves a great day. I'll hang up and listen to your response.
Thank you very much. They're in a tight position, TFI, right? They've said they're quite exposed, of course, to what's going on with the trade war. They
are, more from the point of view that if there's a slowdown in shipments of goods going from A to B, and, even though they operate in the U.S., they operate in Canada, not a lot of that is cross-border, but if all of a sudden you have less stuff coming into the United States, say, and just today I read an article that said over the next number of weeks they expect shipments from China landing at the Los Angeles port will be down like 60%. So we're seeing a real lull in possible shipping of goods, and DHL's put a minimum price on what they're willing to ship, and so on and so forth. So I think if you're willing to look through what could be a fairly extended time of slower growth, slower shipments, TFI would not be a bad place to look. I mean, we saw FedEx get out of the less than truckload, and TFI picks up a lot of that business too. So when things pick up, I think they will rebound to a great extent, but it could be a bit of a wait. Now, we own it, and we have not sold it. We're holding on to it, so we're willing to wait it out.
Yeah, and I guess the point for the viewer is that we don't know how long.
Yes.
And Donald Trump seems to sort of put out a little carrot every once in a while for people saying, "Oh, we're going to deal with China and we're going to negotiate," but China says, "No, we're not negotiating." So some questions there. All right, let's go back to another caller, Bill, on the line from Toronto. Hi, Bill.
People, thank you for taking my call. I'm calling on one of Mike's past picks, Whitecap Oil. I'm a little underwater. Should I buy more, hold, or sell? Thank you very much.
Thanks for your phone call.
Well, yes, it was. I think it was a couple of episodes before this that I recommended Whitecap, but I would still recommend it. All of the energy stocks, the oil and gas stocks, pretty much have been hit pretty hard by the whole idea of a slowdown in economic activity, a slowdown in people's ability to drive and use gas, and everything is going against it. But in the longer run, energy is probably one of the key components of our future development and future growth. So I think that stocks like Whitecap are still they're a better buy than they were when I recommended them, for sure. But I think they're still, you own quality companies that have good prospects of, expanding their reserves and are good lower cost producers. You should be looking at this kind of stock. Yes.
Okay. That was Bill calling on the line about Whitecap Resources. We'll move on then to Deborah, who's calling from Okanagan Falls in BC. Hi, Deborah.
Oh, hello. Good morning. Michael, I always appreciate your expertise on this show.
Thank you.
Today, my question is on Alaris Equity Partners. I bought this stock when you actually recommended it in the $15 range. Mm-hmm. And over time, thank you very much, I'm up about 37%. So my question today is, I do keep it due to the dividend yield of about 7.2%. Is the dividend safe, and where do you see the capital gain growth going, or should I hold on to this company purely for the dividend at this point?
Okay, thanks for your call, Deborah.
Thank you for the question. And, people who've watched the show know that Alaris has, over the years, been a top pick of mine from time to time. And I continue to like the company. I like the way they've structured their business, where they invest in private businesses, but do so through, now preferred and common shares, but with participation on the upside of those businesses as well. So they tend to invest in well-established companies. They're quite diversified now. More of their investments are in the U.S. than in Canada now, and I expect they will continue to do well. I think that, yes, they offer a fairly compelling yield right now, but from time to time it's been even more compelling. But it's it has been a volatile stock. It will fluctuate, I think, to some extent with people's perceptions of interest rates and so on. But I've just thought this has been an extremely well-managed, well-thought-out company. As they've grown over the years, they've further diversified their industrial footprint and their commercial footprint and so on. So I think they're less exposed than they used to be, to some extent, to the vagaries of what's happening in the economy, but it's still going to affect them.
They seem to be doing quite well in April. They've had quite a move up, almost $2 to 18.97. They started out, or earlier in the month, down at 17. Any particular reason for that? You mentioned they're volatile.
Well, they are, but usually when they make a capital investment in a new partner, as they would call them, that's usually a big boost to the stock as well.
Got it. Okay, we are going to take a quick break here on Market Call. Michael Sprung sticking with us to take your questions. We're back in a moment. Welcome back. Time to take a look at Michael's past picks from March 15th of 2024. At the time, he picked Royal Bank, and it was at $134.63. at the time, now at 164.14, so a 22% upside return and a total return of 27%. Royal with sort of a solid from most investors, and you still like it? Yes, I do. I still like it. I still own it. You know, I consider the Royal Bank to be a core holding, really. You know, they have the wherewithal to live through a lot of these economic cycles, but, you know, with respect to tariffs even, one analyst recently did a study of which banks' loan books are the most exposed to tariffs, and Royal Bank came out the least across 5 industry groupings. So, you know, from that point of view, it's good. The other thing is we've seen a lot of volatility in the capital markets lately, and their capital market side is taking advantage of that. So I like the Royal Bank still. I think the yield is reasonable. You know, they've certainly picked up their premium valuation relative to the other banks recently again, but I think they deserve it. Okay. Let's go to your next pick then from March of last year. At the time, you picked Vermilion, the energy company, and I'm wondering, first of all, why did you pick Vermilion back here? It was $15.29. Now it's dropped to $8.96, so a 41% downside, 37% downside total return. What at the time, do you remember why you liked them, and what has changed since that point? Well, we were living in a little different world at the time in terms of oil and gas, and particularly sentiment of the energy sector in Europe. And Vermilion has operations in Europe. You know, lately they've had good success with some exploration in Germany, but whether or not there's going to actually be near-term capital expenditure to exploit that is sort of questionable. Yes, they've been very hard hit. You know, they're trading at half a book value now, which I think is astounding. Their yield is close to 6%. So what would you do? Well, we've held on. Okay. We've held on. I think that as we identify maybe other horses to ride, we could use Vermilion as a source of funds to fund that, but unless we see any imminent danger of any further deterioration, I don't think that we would sell it from here. Got it. Okay. Let's go to your last past pick from last year, which was TELUS at the time, which we have touched on, but we'll talk about a little bit more. When you recommended it, TELUS was at $22.42. It's now down to $20.78, so a 7% drop, but a little bit upside for total return. TELUS, we mentioned, telecommunications company, like many, sort of struggling with some debt load and struggling for growth. Yeah, it would still be my favorite within the group, for sure. You know, we like it. I think shortly after I recommended it, it ran up to closer to 27 at some point, and now we find ourselves back at 20. But yep. All the telecoms have that similar pattern to that. You know, it's just been an extremely well-managed company over the years. Over the years, they've increased their dividend 27 times. I think that it's a pretty good place to position yourself within the telecom sector within Canada. We talked a little bit about what it's moving on to try and decrease debt, which is selling off some of the infrastructure. That's you think that's going to work well for them? I think it will. You know, in some ways you sort of say it's a shame to give up part of that cash flow just for the immediate need of reducing debt. But if you're looking at how you're going to refinance that debt, it could make sense today, just from the standpoint that you don't want to absorb those interest costs going forward. Okay. So, and so would you dip back in at this point where it is now? I would still recommend it here, yes. Got it. Okay. We are going to take a quick break with Michael Sprung sticking around. He's president of Sprung Investment Management, and he's going to take your questions today on Canadian large cap stocks. We're back in a moment. Welcome back. Thanks for joining us. We'll get right to your phone calls. Glenn has been holding on the line. He's calling from Toronto. Hi, Glenn.
Hello. Hello, Michael. Can you please give me your thoughts on Magna, given that it has almost a 6% dividend and it's trading below book value? Would you buy Magna today, or would you wait for a pullback?
Okay, let's have a look at Magna. We'll pull up that chart.
I'm not sure if you're going to see too much of a pullback from where it is now. And so I think if you're considering buying it, you should be considering it based on the fundamentals of the company, which, given the tariff war right now, all seems a little bit uncertain. But, it's my belief that eventually we're going to have some sort of settlement with the United States on parts and shipments back and forth of auto parts and so on. I mean, the industry has developed over some 40 years or more into the state that it's in. And I think already the big auto companies in the U.S. are complaining quite loudly to President Trump that, if he really wants all this manufacturing in the U.S., then there likely won't be any manufacturing for a number of years, and it would take a long time to rejig the auto setup. It has become very, very meshed. And so I would look at either Magna or Linamar. Now, with Magna, you get the advantage of the almost 6% yield, whereas Linamar, I think, is closer to 2%, but it's trading at a steeper price to book value than Magna is. But they're the two senior companies in Canada, and again, I think your horizon has got to be, I'm willing to look through this period, and whether this period is going to be 1, 3, or more years, I'm willing to wait it through, because I think these companies are worth much more than the values they're trading at today.
As you mentioned, they're so integrated. Even if they decide to move forward on some sort of new agreement, the CUSMA deal doesn't expire till next year, and it'll take a long time for them to unpack and decide what they want to do with it.
That's true too, yes.
Okay. Let's move on then. We have Jack, who's calling from Montreal with his question. Hi, Jack.
Hi, first-time caller here.
Oh.
Michael, my question is about Bank of Nova Scotia. I have long been a believer in the Canadian banks, but the Bank of Nova Scotia has been a laggard, and it's a large part of my portfolio. And I've been told that part of the problem, or the main problem, is their holdings in South and Central America. I'm wondering, how many years, how long do you think it will take for them to divest those holdings? And do they have entities to whom they can invest them? I'll hang up and listen for the answer.
Okay, thank you for your question today. Welcome to the show. Let's pull up the Bank of Nova Scotia, Scotia Bank, and get Michael's opinion on that. That's Magna, so we'll switch over to Scotia in a second. There we go.
Scared me.
67.86.
Yeah, I like Bank of Nova Scotia here, and in terms of their exposure to South America, that's been a long time wonder. Sometimes people have said this is really good because it gives them exposure to copper and minerals and things that are need developing, and at other times, well, not so much, particularly with trade influx the way it is today. But I would certainly hold on to it. Management changed just a couple of years ago, and they are taking their focus more and more away from South America, trying to broaden their asset base and broaden their industry exposure outside of that area. And I think they will meet with some success. I think that it's very well priced right now in terms of the big banks. It and maybe BMO are trading at the lowest price to book ratio of the group of big banks. I think the yield on Nova Scotia is quite generous and safe, and so I would not hesitate to say it could be a core part of your portfolio still.
And leave it there.
Yep.
Got it. Okay, Jack, thank you for calling. Let's move on to Mario, who's calling from Mississauga, Ontario. Hi, Mario.
Yes, good afternoon. Can you tell me about Teck Resources B? I should do hard or I should take some money, from the stock.
Okay, we'll have a look at Teck Resources. Thanks for your phone call, Mario, and we'll turn that over to Michael. Teck Resources.
Yeah, Teck, it's a little different company than it was a year or two ago. They got rid of their met coal business, and so now they are more of a pure metals play than they used to be. Again, I think they've been pulled down with the perceived slowdown in industrial production as a result of tariff wars and everything else that's going on. I think that one could take advantage of where they're currently priced now. I don't know if it's going to go much lower or what's going to happen from here in particular, but I do think that they've restructured the company. It's more of a mining play now than it was before. Well, they mined coal before, but that's a different story.
Do they pay a dividend?
They pay a small dividend,
Okay.
as I recall.
So you wouldn't necessarily cash out on it right now? You'd hang on?
No, I would look at it as being potential to add into the mining sector.
Got it.
For
Okay.
sure.
Mario, thanks for calling today. Let's move on to Al, who's calling from St. Catharines in Ontario. Hi, Al.
Hi, thanks for taking my call. My question is on TD Bank, and I was just wondering, at its current price, I'm wondering, do you think that's more reflective at its current price of kind of a catch-up from getting kind of beaten up so much, or at this price, do you think its valuation is getting just a little rich? I'll hang up and thank you again.
Yeah, we get a lot of questions for TD, right? Because they were down so much in December after getting penalized in the U.S., and people want to know if they should dip in, if they're going to get an upswing there.
Well, I think that with the money laundering problem that they suffered and the steep fines that they paid, that's in the rearview mirror now.
Okay.
And so going forward, it's a question of, TD Bank is probably more exposed in the U.S. than a lot of our other banks. They've certainly made a huge amount of investment down there, and it is trading at the higher side of a premium to the other banks. I mentioned before that Royal's really got the premium multiple on at least price to book right now. TD is up there again. But, if you're a long-term investor, I think that the worst is behind them. And, people are looking for yield, and the yield on TD right now, I think, is fairly generous. It's close to 5%. So I wouldn't hesitate to have a position in that.
Yeah, and just a note, so last fall, I guess last September, they were at 87.52. So they've climbed back up quite a bit since December.
Yes.
Okay.
Yeah, they have.
And would you still dip in then, or will you just hold a position you have?
Well, we don't have a position in
Okay.
TD right now.
But if you're advising someone to do so.
But if someone was looking for a bank to add, I think there's others that would be my favorite, but I wouldn't have anything against an investment in TD.
Got it. Okay, we are going to take a quick break. Michael Sprung is sticking around. Sprung, excuse me. We're back in a moment. Stay tuned.
I think so.
And stick with BNN Bloomberg. This evening, we have comprehensive coverage of the federal election. At 5 p.m. Eastern, we're going to switch over to CTV's Power Play with Vashi Capellos. And then at 7 p.m., it is the CTV Election 2025 special results analysis perspective from all across the country. The coverage will carry on until 2 a.m. Eastern time, so stay tuned for that. As we get back to our phone calls here on Market Call, we have David on the line today from Calgary. David, how are you?
Fine, thank you. Thanks for taking the call. I have quite a bit of cash, a lot of cash in my RIF, and I plan to leave it that way indefinitely, maybe forever, because of our age and things like that. I'm wondering if there's something that could be an investment that would put it into kind of like what would be a savings account and earn 2 or 3%, a small amount of money for a long period of time, and leave it. Now, I know there's a product called cash. Is that something? Thank you, Michael.
Okay.
I don't know the product specifically called cash that you're talking about, but there are a number of high-income money market ETFs that I think you can look at. And so, that's one place you could start. Right now, yields on the short end are not that generous when you look at some of the dividends that you can get paid. But, you made it quite clear at your age, you don't want to take the equity risk. So, looking at cash is not a bad idea. It's just that if you were to look at bonds, yes, we've seen a steepening in the yield curve lately, but still the far end out there is not a great deal higher than the lower end. So it doesn't really pay, I think, to go too long in duration, because if interest rates start to rise again, which they could if we have a really booming economy, which may be a long time away, but they could be ratchet back up. That's where you would be hurt. So, I would look at things like high interest savings accounts, money market ETFs, that kind of vehicle. I would expect you're going to be seeing yields in the range of 3.5%, maybe a little bit better in some of them.
Which is what he's looking for, essentially.
Yeah, and I can certainly understand why you'd hold a great deal of cash if you're really, really worried about that equity risk in the future.
Got it. Okay, let's go back to the phone lines. Peter is on the line with his question. He's in Vancouver. Hi, Peter.
Hi, thank you. Mr. Michael Sprung.
Yes.
One of the best and my idol. A few years ago, when CIBC was really down and majority of analysts are negative, but Mr. Sprung favors it, and in 2024, CIBC was up 40%, the best of the big six. Thank you very much, Mr. Sprung, your expert opinion on CM. Thanks.
Okay, so CIBC, I think, was the question.
Well, it's still one of our larger holdings in the banking sector, that and Royal, and we do have some BNS as well. So let me be upfront about that. I still like CIBC in terms of their exposure to the tariff regime. They're sort of in the middle of the pack. So I don't think that's a really big factor with them. The thing about CIBC right today is valuation-wise, they've snuck into the sort of higher half of the bank valuations. Comparing it with a Royal, I'd be sort of even tempered in terms of which one I would choose. But I think that it still remains one of our top holdings and probably will continue to be so.
Okay, let's go to one last email here, which is an email from Mike. He says, what's your take on Manulife Financial for a long-term hold? Would you add to the position at the current price? So let's pull up Manulife and see where they are at this time, 42.23. So they are down, of course, this year, when you look at the fall off in sort of February and then the fall off in late March, early April, maybe there. So 42.22 is where Manulife is today.
Yeah, people know that if they've watched this show, Manulife has been one of my favorite stocks over the years, and it continues to be. I think they were the life co that was hit really hard in the great financial recession 2008, and they cut their dividend in half, and they were not forgiven for a number of years. But I think since then, under the leadership of first Don Galoin and then Rory, they've done extremely well. They are now going to have a new CEO again, but I think they have repositioned themselves. They're in good growth areas. Both Manulife and Sun Life, for that matter, are exposed to the Asian market. So there are some possible questions there, but they both have great growth potential in that area. So I wouldn't have any hesitation to say Manulife is and will continue to be one of our core holdings. But
because they have that exposure to Asia and China is so heavily affected, is their exposure specifically to China or Asia more in general?
I think, well, they're spread across Asia. Okay. Certainly they do have interests in China, but they are spread across Asia. As a matter of fact, I think Rory, before he became the CEO, was head of the Asia area for the Manulife Bank. So, I think they're well positioned there. The only thing is, price to book wise, well, between them and Sun Life, there's not a whole lot of difference. You pick up well, there's hardly any difference in yield either. So, it's half a dozen of one or the other really right now.
Got it. Okay, we are going to call it for phone calls. We do not have any more time for that. However, we are going to keep Michael around. He's going to share his top picks. That's coming up next. Welcome back. And again, thanks for joining us. Let's get to top picks. We have a first one here from Michael. It's Sun Life Financial, which we touched on a little bit, Michael, but if you want to expand on why it's a forward-looking pick for you.
Sure. As I was saying, I'm somewhat indifferent between it and Manulife at the moment, but Sun Life is a top pick today. After their last quarter, they were penalized a little bit. They had some bad experience in some stop-loss insurance that was on their books. They had a small impairment from an investment in Vietnam. And there were some softer flows at MFS, which is their big investment arm in the U.S.
Okay.
And, policyholder experience in insurance companies is part of the way things go. Sometimes you have poor experience, sometimes you have favorable experience. Actuaries spend their life trying to sort of say, okay, over the long term, what is the likely experience supposed to be? So it pulled back a bit after that quarter, and I think it's now in a range where one could say, again, it's one of our core holdings within the financial sector. It and Manulife are both part of that core holding, and it has a yield over 4%, which I think is pretty safe. I think it's an extremely well-managed company, and I wouldn't hesitate to recommend it here.
Okay, let's go to your second pick, which is Hudbay Minerals, which has operations in Canada, the U.S., and also Peru, which we were touching on during the break, because it's always some of the outliers that you have questions about how operations run in other countries. What's your take on Hudbay?
Well, Hudbay tends to operate in what is considered less politically explosive environments. They're not in Africa. They've been in Peru for a number of years. They have a major mine there, which continues to expand, and they continue to broaden out the reserves there and do very well. Just recently, they bought out Mitsubishi, had a 25% interest in Copper Mountain, which they're going to be developing going forward in Arizona. And, that's a fairly safe jurisdiction to be mining in. I think there's going to be some future growth from that. Down the road, as I say, they're going to expand operations around Constancia. And they have a Maison project in Manitoba, which is also going to be developed. And just today, actually, they had two items of good news that I saw flash across my desk this morning. One of them being that their CFO was named the Globe and Mail's Best Executive Award, which is quite interesting. And they described in that announcement, how he manages and how well he's liked within the company. And the other thing they announced today was they have reached an agreement with the Cree Nation on their Talbot deposit, which is part of the deposit in Snow Lake in Manitoba.
Okay.
And so those were two good pieces of news. Going forward, if we're going to have this electric world that people are talking about, or even if we're going to tend towards more electric and more power and more utilities, you're going to need a lot of copper. They're a copper-focused mining company, but they also have zinc, they also have gold. And as a mid-tier, I just think that they represent relatively good value at current levels.
Got it. Okay, let's move on to your third pick then, which is Canadian Natural Resources, CNQ on the TSX. What do you like about Canadian Natural?
Well, I think it's one of the best managed companies in Canada. And as we were saying earlier, all of the oil and gas and energy stocks have pulled back with the recent rumblings about trade flows and tariffs and industrial demand and economic activity. So I think right now you have a real opportunity to invest in one of Canada's best companies, one that has a lot of future growth potential through their oil sands and their upgrading facilities and their so on. I think with a nearly 6% yield, it is a pretty good company to hold as one of the core you would have within the energy sector of your portfolio.
Okay, and you see some traction for them moving forward?
Oh, a lot of traction.
Got it.
Yeah.
Okay, we do have to leave it there. Michael, appreciate you joining us on the show. Thanks for coming in.
Thank you.
And we will leave it there. Let's have a quick look at the markets as we go on Election Day in Canada. We'll see you again tomorrow.